Yeah, so gentlemen, good evening and welcome to September's edition of the AS webinar. I think today we are very privileged to have one of the strongest guys in Ghana right now when it comes to financial literacy. I mean, this is a man that has, when BBC wants to talk to somebody, about investment in Ghana, they call him. So I need not talk too much or hype him too much. I think I'll leave the floor for him, and then you'll be the judge at the end of the session. So, Richmond, this is a team. Akateche, we call ourselves the Freedom Fighters. All right. So, please go ahead. The floor is all yours.
Right. Thank you, and good evening. Thank you for the opportunity to meet these freedom fighters. I had to extend my time by about 45 minutes because I was on another session in the Parliament of Berlin. So forgive me for that. So I've not even left. I just decided to step aside and make sure this happens. Now, I'm sure for today, basically, I'm just going to be talking about how you can leverage on the financial services universe and maybe limit ourselves to Ghana for starts. So these things I'm going to say apply to you if this is the picture. This picture applies to you. So number one, if about more than 60% of your total income is largely dependent on your earned income. Earned income meaning maybe you work and you get some monthly income, or you have one big business and it gives you some major return. And that is a main source of your total income. And 60% depends on just that. Then I'm challenging you that the numbers so far show that you are going to struggle to survive when you decide not to live on 8 to 5 job. Number two, out of every 100 Ghanaians today who work either on their own or even work for government or work for any well-doing private sector, who decide to retire today at age 60, not 45, not 50. Ideally, it's supposed to be 45, 50, or 55. But anyone who decides to stay even up to 60 today, out of every 100, only 2 can retire and still live on the same, keep the same standard of living or do more, and nothing will happen to their finances and they will be comfortable. 75% will have to depend on SNIT or any sort of retirement annuity income they put together, either through tier 1, 2, or 3. Unfortunately, data suggests also that people who even depend on either 1, 2, or 3 tiers of pension, about 85% at the moment earn less than 1,000, even the high income ones. And so that is also another risk area you have to check. And then the outstanding 25% out of these 100, they would have to still work even beyond 60. And in addition to working, they would have to depend on, they have children if they are well-to-do, or family, or any other source that can help them. So number one, if your biggest income composition that powers your finances today thrive 60% and above on earned income, meaning income you make through regular monthly earnings, weekly, or any big business you do, then it applies. And number two, if you are looking to retiring comfortably, then I'm saying that even assuming you decided to wait till 60, for every 100 working Ghanaians, only 2 can retire comfortably. 75 will have to depend on the pension system. And I've explained what the pension system is currently. And number 3, the 25% will have to, even at 60, in addition to the SNIT, the tier 2, tier 3, still have to work in order to be able to keep the same standard of living and do more and be comfortable. Number 3, if you want to do well again, and apart from an outlier, like maybe a disruptive family inheritance that puts you in a tier 1 category of wealth, but you want to do well as a middle class person, then you need to generate a minimum regular income sources of not less than 4. So earned income becomes 1, portfolio income becomes 2, franchise income becomes 3, and then residual income becomes 4. I'll explain them, I'm sure, as we go along. So this is my preamble to saying that whatever I'm going to say applies to is very significant for you if any of these statistics I have shared makes any sense to how your finances look like. In another setting, one day, if we get the opportunity, there are 2 critical diagnostic tests you will do in any meeting I attend if I want to make it very pragmatic and individualistic. And when you come out of those 2 diagnostics, the answers will tell you whichever state you are and what you need to do and the time you have to correct it if you want to do that before you decide to chicken out of the regular race of working for earned income. So it's important to understand the financial services universe so that you would be at the leverage end where you benefit from whatever system it is and rather not become a product of its outcome or a victim of its consequence. And so the universe is just bordered on 4 critical pillars. There's banking, there's pensions, there's insurance, and investments. The entire financial services universe, banking, pensions, insurance, investment, and they must all work for you with a certain understanding. Today, I'll just introduce us to the 4, and then I'll just talk briefly about each of them and how to leverage on them, and I'll end. We take Q&As, and then as and when we get another opportunity, we can delve deeper. Now, the banking system is simply nothing complex. It's an intermediary system that sits between those who have and those who don't have. Those who have and do not leverage on it only keep their money in a regular current account or savings account. And those who don't have also don't leverage on it, decide not to leverage on it because they don't understand it. Also only utilize them when they need a debt or when they need some credit or when they need a facility. Now that intermediary system leverages on either parties wherever you sit, and you must understand that so that you can also leverage on same. Number 1, when you're on the side of those who have and you want to put money in the bank, it is okay to save. It's one of the best things that anybody should do. And ideally, you should be able to do not less than 6 months of your total monthly regular income at the moment sitting on any regular account you have. And it serves as a buffer, which we call an emergency account. So that in case there's any disruption in economy, disruption in anything that affects your income, you are able to hold steady your finances for at least 6 months. And the rule of thumb says that. So if you cannot say, I earn X amount today, every month, and I have that X amount times 6 sitting somewhere that I don't touch, you are a very good candidate for poverty, so to speak. So that must be stuck somewhere. It is not money that you fall on us and when, it's money that is stuck somewhere just for a day of an emergency, good or bad. An emergency can be good, can be bad. Good emergency can be an opportunity comes up, somebody wants to sell some big thing cheaply. You have the money today, you leverage on it and big the assets. The bad emergency could be something happens you never planned and you have to fix it with money. Now you don't have to go and break your entire investment. You have an emergency account that can cure that and you are back to stability financially. Those who have, this is how you leverage on the banking system. You mobilize into savings and you do very little transaction on your current account because that transaction account comes at a cost to you. So anytime you are using a transaction account, you should make sure that whatever you are using that current account for, it's bringing you more than the bank is charging you. So those who have, that's how you leverage on the banking side if you are putting money into the bank or if you are depositing. Now, beyond just the crutch of just putting the money into a deposit account, one thing you do also to leverage on the banking system is to move from savings into minimum investments. And the same bank that you have your regular account, if you mobilize a certain substantial amount, you can ask them to move the funds that have sat in the regular account for the last 3 months at no interest. Or if there is, I mean, averagely Ghana is paying about maximum savings account that is paying so much will not be more than 5%. Inflation is now at 30 plus. And so even if you thought that keeping the money there for the last 3 months is giving you something on savings, take away inflation and you are back to negative 25. So already the money that is sitting has no value, and you have to look for 25% to bring it to the value that it used to be, no interest. So you negotiate with the bank to at least bring you at par to where inflation is equal or more. And you do that through fixed deposit or commercial papers or bankers acceptance or any of the instruments they may have, the same bank account. So those who put money in that on that side because you have something to keep away, this is how you leverage on the bank. And those who do not have credit, debt is not a bad thing. However, the last thing you want to do is to fall on debt instead of falling on your own funds if you have. Why? Because any credit you take at the moment, you are likely to pay not less than 3 times whatever you have taken. And so whatever you are using that also for, should be able to pay that 3 times before you take it, other than that you'll be working for that intermediary institution. And so you must be able to sit in between these two categories and leverage on the banking system to your advantage. That's the basic understanding for today. Then I come to pensions. Pensions is simply about you planning your retirement. And usually when you talk about pensions, you will see that everybody's mind goes to 60. Now, imagine the kind of life we live. You wake up so early, you close very late, you travel, go up and down, working. You have no time even for yourself and for many things. I don't think you want to live this kind of life for the next 60 years. If it's possible and you have the chance, you should be able to retire earlier and enjoy your life and do what you love to do. That doesn't seem like work, and enjoy yourself and do all that you do. And still not be stressed financially. That is real retirement. And ideally, maximum 50. If you have the time and the money, you should be planning towards retiring from active 8 to 5. And to do that, you have to be deliberate. And it doesn't, you can't just get there by just concentration on tier 1, tier 2, and tier 3. There's more to do. But at least to start with, you must understand your tier 1, tier 2, and tier 3, which is the pension system currently Ghana is running. The tier 1 being mandatory, Senate manages that. You check it as frequently as you can to be sure that all the contributions since you started working are reflecting, and you know the average amount, and you let them calculate for you, assuming you are retiring on that same kind of contribution, how much you're going to get as an annuity. Because Senate will not pay lump sum again by the 3-tier system. Senate will pay you monthly till you die. And then the tier 2, which is now privately managed, will pay you a lump sum. And so you check the Senate, and then you check who is handling your tier 2 if there is that contribution. Because if there's Senate payment for you, then you automatically, the tier 2 is mandatory, and so you have tier 2 as well. You have to check that, get to know your trustee, who is managing it, get to know the fund managers, get to know the custodian, understand it, get to know the statement yourself. So you're able to tell the day you are leaving, the lump sum you get from them and the annuity you get from Senate, how it's going to play out, to take you out of the statistics I shared between 100 Ghanaians, every 100 Ghanaians will retire. Then there's tier 3, and in that tier 3, there's personal pension and there's provident fund. Personal pension, you control it. You decide what you want to do, and you put that amount in at the frequency you want to do it. So you don't just depend on provident fund. You can create your own pension through the personal pension under tier 3, and even earn more exemptions on tax, so that beyond 1, 2, and 3 provident, if it applies in your organization, you also drive and determine yourself how you retire, how you live after, say, 50 or 55. So that is on the pensions front. I come to the next one, which is investments. And here I've explained bank and I've explained pensions. Investment is in the 4 different incomes I share that you should have. Investment is the portfolio income. Portfolio income is simply an additional income you generate without you necessarily showing up to work. So you work for money for your end income. Then your portfolio income through investments gives your money the ability to work even harder than you. And to understand that, you must understand both the capital markets and the money markets. One at another time, I'll explain that. You leverage on both. Yes, investment has risk. You need to understand, you need a lot of things, but the risk in investment is very, very nothing compared to how well you are able to make a lot of great wealth if you understand what to do, where and when. And I'm sure at another platform, I'll explain that. And then the last one is insurance. Insurance for many people is misinterpreted to mean investment, not necessarily. Insurance is a safeguard against a risk potentially. And so insurance naturally kicks in when that incident happens. So when you are insuring, you are saying that I'm anticipating that something negative can happen one day. Now, when it happens, it is going to cost me financially. And so I'm putting together a safeguard that will bring me back to the state I used to be, assuming that incident happened. So if it doesn't happen, nothing applies. Many times I meet people who say, do you have an investment? So yes, I have a policy for this, a policy for that. That is not an investment. It's a safeguard. And so you cannot misinterpret that insurance policy you have with investment. They are 2 different things. Again, at another time I'll explain, but largely there is life and non-life. The life in Ghana is what you hear as assurance, and the non-life is what you hear as insurance. So they are general insurance, and then there is a life assurance. So the entire financial services universe can work to your advantage if you understand these 4 critical pillars. The banking is regulated by the Bank of Ghana, the pensions by the MPRA, the insurance by the National Insurance Commission, the investment by the Securities and Exchange Commission. This understanding is the basics that any working class, middle class, freedom fighters like yourselves must appreciate. And that becomes a basis to building a financially independent future. I'll be ending here as this introduction, and then with time, I'm sure we'll have some more chance to go deeper and to know what to do when and how. Thank you so much for your time, and I'll be ready to pick some questions. Thanks.
Thank you, Richard. That's been very insightful and concise. I would like to open the floor to everybody. Of course, I would want to start by asking that currently the T-bill rate is below inflation. What would be your advice to us? So, for instance, last week I didn't check, but the last time I checked, I think T-bill was in around 27. Somebody hinted me that it's hit the 30s this week. But inflation that they reported last week suggested that inflation is now at 37 towards 8. So even T-bills, which normally seem to do better than inflation, is below inflation. So with the suggestion you made that try and put your money when it comes to the banking system into areas where at least it is at par or better than inflation. In Ghana, which areas could this be, and what would be your suggestions in that regard?
Okay, so first, this is a good question. First and foremost, inflation is, I think, it's not even up to 34 yet, not yet. I think it's about 30.
No, inflation, we are at 37. Oh.
For which month?
The last one the guy read like 2 weeks ago or last week.
Oh, it's 33.96
no.
or something.
I'm an industry man, so
really?
I know the rate of inflation.
33.96 or something.
Yes, it's 33.9. Yes.
Okay.
Yes. So first, that is the rate of inflation first. 2, Treasury bill has also crossed the 30 mark. That is another fact. Howbeit, you are right to say that, well, even if I decided to buy a treasury bill, at the moment, say 91-day treasury bill rate is a little below inflationary. That is correct. As at this week's auction, the 91-day treasury bill has passed the inflationary rate, the headline inflation rate for the month of August. So for nothing at all, still the 91 treasury bill is still ahead. Number one, it gives you value. If for nothing at all, it keeps your value intact than if you kept it in a regular account at 5%, which brings it to negative in value terms. However, that is not the only thing you do in investment. In the same bank, if treasury bill is doing 33, fixed deposit can do more than that, because fixed deposit is supposed to pay more than treasury. So you ask the bank for that, you negotiate for that, and they'll be able to do above treasury and inflation. Beyond that, also, treasury bill is not the only investment you do. To take any significant investment decision, there are about 5 questions you answer. Number one, what is my objective? If my objective is to use this money to buy land, it defines what investment products you buy. Number two, what is my duration? When do I need this money back? Money I need back in 3 months and money I need back in 3 years should not be put in the same account. If I need the money back in 3 years, I don't need to buy 91-day treasury bill, because 91-day treasury bill would not give me what an investment that I put away for 3 years will do. So duration is important. It defines what you do. Number three, risk. What is my risk profile? And I will make it simple in this way. If the money you are putting aside, you are worried about, how should I put it? You are worried about, just hold on, let me, I've written something down for you. Let me read that in a verbatim for you so that it spells out risk in a much simpler way. 1 second. If you are worried about the return of the money you have put aside more than the return on the money you have put aside, two different things. If you are worried about the return of the money you have put aside, will I get my money back when I need it? If that is a greater concern than the return on, well, how much I can get today. If getting it back is more important to you than the return on, then you are risk averse. You should define where you put your money. There are some people, they don't mind if they put money there and they know in 5 years it's going to double. But between now and the next 5 years, there are days I will go and it will be below the principal is growing. I'm not disturbed. The others, no, they can't. They can't even sleep when they notice that the price of the share they invested has fallen by, say, a cedi or $1. That risk orientation even defines and determines where you put your money. So that is the third thing you ask yourself. And then the next thing you ask yourself is where to put the money. So my point was that in answering your question, I've explained that yes, treasury bill can actually cure the problem you cited. If treasury bill can't cure that, ask the bank for more. It may be a fixed deposit, it may be something else. But largely, ask yourself these 4 questions and go even beyond the banking system or the pillar and jump into investments and use these 4 or 5 questions to now tell whether I should buy a bond, whether I should buy a specific listed equity, whether I should buy a commercial paper, whether I should do whatever. And I think at another time, I'll take my time and explain when we get there. So either way, you are worse off if you don't take an investment decision because inflation is high and treasury bill is just up at the rate of inflation. Why? Because if you decide not to put your money into treasury bill, the rate of interest on holding your money is 0 and inflation is beyond 30. So it's negative already. So when you take an investment decision receiving treasury bill, it preserves at least the principal and keeps the value and your standard of and cost of living at the same level. At least that is a protection. And then you jump up, you move further with the questions I answered to now do more so that your portfolio income can earn something for you. I hope I've been able to answer.
Yes, please. And thank you very much. My last question before I bring others like Frank and Co in. One of the challenges in this part of the world is the fact that we almost work hand to mouth. In other words, We live paycheck to paycheck for a lot of us, or majority of us. Our salaries not is almost not enough for us. But then again, we have to plan for our retirement. We need to sort of, based on at least the lecture you've given us, we need to save, we need to invest. You know, in the midst of all the challenges we are facing, and we would also need to probably build a place where we'll retire into, take care of our kids in, you know, university, secondary school, etc. What's your advice to the Ghanaian man? What do we do? As in, one, pay no already, but then you still need to look this far. Are there any special investments that probably helps? Are there any skills we need to build? Any rules of thumb you would want to share with us in an environment? I work at the ministries, probably my take-home pay is 3,000 cedis a month. In 10 years, my kids are in secondary school. What do I do? They will be in the university in 15 years. I also need to build. I'm retiring in 20 years. What do I do?
So, I mean, yeah, so right. And spot on. How be it? Building immunity in the face of all these challenges has zero to do with how much you earn. I'm talking about the amount, how much. But then it has everything to do with how much you leverage whichever amount you make on the 4 financial services universe I just explained. So it's not how much you make, it's how much you keep and leverage in the pillars I shared. And I think at the right time, I would do a simulation where you would be able to subject your present income against the realities you face specific to you. And in my new book, Good Money Habits in Bad Economic Times, there is a diagnostic tool you go through personally. And when you are done, it gives me whatever is left with you, or even if nothing is left. And then we take you through what you have to do. And like I said, it has very little or zero to do with how much you earn. And you'll be amazed. All you need is time. So if, for example, you have 20 years to retire, we can take the next 15 years to say, look, this is what we want to do so that by the next 15 years, I'll be able to hit into the category of, say, $1 million that can take care of all these things I have itemized. And that will mean you need to take decision 1, 2, 3, 4, 5. And it's more of time than the amount. So there is a way out. But we can't discuss all that in this short time. So number one, I'll recommend to you my book called Good Money Habits in Bad Economic Times, a 206-page book that is very pragmatic and shares how you are able to come out of all the time, even in bad times like this. And then maybe when we get another chance, I'll walk you through that. If, for example, you are earning even 1,000 and your expenses are just about 800 and you're left with 200, how do you build financial immunity and be able to do all the things you want to do with just 200? And even build some additional income through that amount you have, particularly if you have time. If you don't have time, there's nothing you can do. You have to do some other things you will learn. So maybe this is what my attempt will be at answering you.
Sure. I'm grateful. We will pick details about where we can get your book after, when at the tail end of this meeting. So thanks. I look forward to getting a copy of your book and then learn more. And of course, through Saint, we would hopefully have you again as soon as possible. Frank, please go ahead with your question.
Yeah, thank you, Mr. President. I also have 2 questions. My first one is when you were talking about the 4 things that you talk about, the banking, pension, insurance, and investment. I want to ask a question more about the investment part. So, you explained a little bit everything good about the investment, but for us who live outside the country, what kind of investment advice will you give us, especially if I know for us it's going to be a long term? You were talking about 3 months and maybe a year or whatever. For us, maybe it's going to be like a long term, like years, about 4, 5, or even 2, 3, 4, or 5 years. What kind of investment would you recommend, especially looking at the, as you said, the financial situation we have now? And my second question to come with maybe what Nana was also saying about, let's say we have a few people that they have a lot of things that they need to do to live, whether it's like taking care of their family and all those things, and we are talking about saving that little money that they also have. So in that way, my question comes with, is there any way as a group like we have, like year groups and stuff, is there any way or any recommendation you give when it comes to a group investment or something like that, whereby, you know, in other way, we always try to find out how to help each other, but we can have a group investment whereby even it will help those who don't have much to be able to also participate in investment. Thank you.
Okay, so I'll start from below. First, group pools work. In fact, there are a number of examples I've done for people living in Europe. The latest is a group of people in London, and I think last 2 weeks I was in London, and we started something just before COVID for a group of men, about 20 or so, and we leverage on pooling, paying just about £50, £100, something. We did a simulation for them, and at the moment, that group pool account has been able to invest and buy some of the townhouses in London and rented out to other people. And when the rent comes, the group shares the returns in the group pool and the contributions they have done. There is a way to do that. Like I said, because of time, we will not be able to go into this. So yes, it exists. We can put you together, build a group pool, or we can do a club investment account so that every little amount counts and it's able to use to buy big things, and then you share the returns amongst yourself. That is one. Two, those outside, you even have better leverage. So I talked about two things. I said that the short term is just a cure. But really, if you want to take a long-term investment decision, you must answer the 4 questions I posed: the objective, the duration, the risk profile, and then where to invest. If you're in Europe and your objective is long-term, that is one of the best places to leverage. All blue chip stocks. I mean, I'm in Berlin, but I don't live here, but I take critical investment decisions here that return more than if I was putting my money to work anywhere in Ghana. So if you're outside, the capital market is one of the best places to put money. You don't need to have a Facebook account, but you can have a Facebook share. And when Mark recounts his league, the earnings on the share, you earn some. You don't need to have a Twitter account, but you can have a share. You don't need to have an iPhone, but you can have a share. So yes, even those of you in Europe, either back home or in Europe, there are leverages and tons of investment opportunities you can leverage on. We just need to pragmatically go through the steps and the 4 things so that it is specific to why you want to do it, how you want to do it, and things like that. But it's possible. Investment has little to do with how much. It has everything to do with the time and then what you keep. I pray I'll be able to answer this as well. Thank you.
Thank you.
Okay, thanks. Della, please go ahead. Della, if you can hear me, please go ahead. Oh, sorry, it's Daniel. Apologies, Daniel. I'm sorry. Daniel, please go ahead.
Okay. Thank you, guys. Thank you, Mr. Frimpong. I've been listening very attentively to everything you've said, and thank you very much for the insight. I'm just a bit confused in terms of the investment aspect vis-a-vis the banking situation in terms of interest and on all that. Right. My question is that, is it advisable to like go for a loan to invest? Would you advise? I'm speaking from the UK, so right. I believe you understand the banking system a little bit in the UK.
Yes.
It's not as dire as well as the inflation rate in Ghana now, but it still comes with consequences.
Right.
But then, would you advise going for a loan to invest?
Okay, so 2 things. A loan on any day is not a good idea. There is nothing like a good debt. That is a reality. Howbeit, when it becomes necessary that you should take a loan and you're taking it to invest and not spend on a consumable, just be deliberate and do 2 things. Number 1, get guaranteed certainty of the return it is going to give you. You don't take a loan to invest in something you're not too sure about, particularly because you are taking it to invest so that you'll be able to pay back and make more. So get guaranteed certainty in terms of the return it's going to give you. And make sure the return it's going to give you is more than the costs or the liability of taking the loan. So what you do on the loan side is to get the exact detail for the duration you are paying back and the total cost of paying back, both the amortized and then the interest. You should know it from day one, so that you know that if I take £1 in 10 years, I'm paying back £5. If I take this £1 and I put it here, in the same duration, I'm going to raise £20. If you don't do these 2 things, don't attempt taking a loan for an investment. But if you do these things, yes, you can attempt the same.
Let me clarify something. Sorry, it is something that I've been struggling for a while. We want to come and do a bit of investment back home. Normally the climate, the investment or the business climate in Ghana can be very can be full of uncertainties. So assuming I'm trying to say buy some trucks to work in Ghana. Okay, my projections prior, before I raise the capital to do that, it's very good. However, like you said, political climate, economic climate can change all the time. However, but maybe my money that without borrowing probably will not suffice the kind of investment I would like to do. That is why I was saying, would you advise something like that? Because it is different borrowing to invest here and then borrowing to invest back home. It can go either way. It can make you a very good substantial returns, or in a flash will sink all your money due to uncertainties. That is why I asked that. So I don't know if this clarification will change what you've just said.
It does. It doesn't change. So it only rather clarifies the uncertainty of the investment type. You see, particularly when it's a business, you can't really tell. I mean, you can do all the cash flow analysis, you can make your projections on how the balance sheet will look like and things, but the outliers you don't control. And so the only reason why you still take a loan to get into that would be that, assuming the indicators don't play out, you would have another way out to pay the cost of the loan. If that cannot be determined, then don't put it in an enterprise that you cannot entirely predict.
Are there any predictable investments that, come what may, will not alter in Ghana?
Yes, there are. So 2 things. So after you've done, if you still want to put the money into, say, the tracks and the things, after we've done all the real analysis on them, then you calibrate how you put that investment into it. But you build what we call a buffer. So let's say I want to start this project in the next 3 years, and time is more important here. In the next 3 years, today, this is the value. In 3 years, this will be the value. So in the next 3 years, if I take the loan, I'm going to put it here to return so and so. And you can do that even from UK without buying any investment in Ghana. You can buy a Ghanaian investment like a Eurobond from the UK or from the London Stock Exchange. And strangely, a Eurobond you buy from the government of Ghana in UK pays you more because it will be dollar denominated than if you bought it in Ghana. And particularly in bad times, you leverage more because the government needs money. So when you lend through a Eurobond, you pay more. Why? Because in these times, the government is crowded out. And so any money they take from the capital markets, they pay more. So my point is that, yes, we can program that loan and you put a significant amount into an instrument like that and now scale the return into such a project so that you are able to pay the loan and at the same time also scale into your project. And then just in case the uncertainty setting, you are not brought to ground zero, you still will be able to figure out. If it works also, then you have built two multiple streams that will be propelling and even reinvest into the business and the price you have done. So yes, there is a way out. We just need to sit down and go into the details.
Thank you. Thank you.
Okay. Please, does anybody have a question or we are good to go? I don't see any hand up. Okay. All right. So now that I don't see any hand up, the assumption is okay. Jeff, please proceed. Mr. Quentin, proceed.
Okay, so Mr. Frimpong, thank you very much for your insight. So I just wanted to find out, would you advise that, I mean, you have advised that it is important that you know how much the, assuming you're taking a loan, how much the loan is going to return as against how much the liability of the loan is. Is it okay, or would you advise that you, for example, borrow to invest and then pay back, for example, if you're on a salary. So if your salary can accommodate the loan, you borrow and then pay back with, for example, your salary, while you invest the loan in another venture that may bring a return that is obviously more than the liability that the loan comes with. Is this something that you would advise?
I mean, you have given me two sureties. Number one, you are saying that the cost of the loan is within your ability to pay through salary. Number two, you have assured that the investment you are putting the loan to is of great return and it will be more than the cost your salary is paying. If these two sureties are certain, why not? You can go ahead.
Okay. Okay. And then the second question that I would like to ask, thank you very much for that. The second question is that, would you advise that, assuming the investment that you put the facility to is able to return enough to pay off the loan within a shorter period, would you advise that the loan be paid off rather than wait for the end of the facility to mature?
Very good question. Any day, anytime. Any loan that travels longer costs you much. So if it works in the equation for you and you are able to pay earlier, that's why when you say I'm taking a loan for 3 years and I'm paying in a year, the bank penalizes you. Why? Because you have cut short their projections that they were going to make on the loan for the duration. So it's good to pay quicker if you can, so that you cut off the losses.
Okay. Thank you.
Yeah. Okay, great. Please, any question? Okay. Now that there are no questions, Richard, we would want to say thank you very much. I already said that we would want to know where we can get copies of your book, Money Habits in something times. So if you could direct us where we can get some, And then, of course, through Saint, we'll get back to you and leverage on the vast resource you are and see where we can meet each other and, of course, for mutual benefit as a group.
Right. Thank you. So this book is actually is being launched in the first week of October. So it's pre-order stage.
Okay.
So it's coming out. Yeah, I think the first week of October is ready. So it's
Okay.
pre-order because we are printing a few copies. So I'm sure when you talk to Saint and we know the number of orders, you can reserve yours.
Okay.
Just in 2 weeks away, they'll be ready.
Okay. And are there digital formats or these are all
Yes.
Okay.
Yes. Digital formats. Yes, they are available. Yeah.
Okay. All right. So on behalf of the Academy AX group, I want to say a very big thank you. I appreciate the fact that you are in another environment where, if my timetable is correct, you are 2 hours ahead of us, and you still managed to make this meeting. Thank you, and definitely we'll reach out back to you for another session with you. For now, AX Group says thank you and all the best to everybody. Let's take the lessons from today and let's have testimonies after. Thank you very much, everybody.
Thank you.
All right. Bye, everybody.
I have a good weekend. Maxi Menko.